Welcome to the Teaminvest Wealth Builders podcast, where we bring you insights, strategies, and stories to help you build and compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. Whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. This week, we're joined by TIP's CEO, Andrew Coleman, and our Head of Funds Management and Education, Sanjay Narendran. Sanjay and Andrew have a discussion around capital killers and wealth winners. So what are capital killers and wealth winners? And how do we distinguish one from the other? We'll then step into having a look at some really well-known companies. Companies like ResMed, Telstra, Lendlease, and JB Hi-Fi, just to name a few. So why don't we cross over? The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs.
Welcome everyone. On today's episode, we're going to talk about two things that are words we've coined in Teaminvest. In fact, they're trademarks that have started to become market lexicon. The first is a wealth winner and the second is a capital killer. So what do we mean at Teaminvest of a wealth winner? Well, what we mean is a company that will materially increase the value of your wealth over time through your investment because it meets 7 key criteria. And we'll talk about what those criteria are. And what do we mean by a capital killer? Well, that's something that will materially decrease the value of your wealth if you're unfortunate enough to own it, usually through a combination of significant capital value reduction based on either its clear indication of potential risk or what our wisdom of the crowd has identified is a problem just around the corner. I'm joined today by Sanjay Narendran, our Head of Education and Funds Management, and we're going to do a little bit of a back and forth from one wealth winner to a capital killer. Now, the advantage we have, of course, of picking these 4 wealth winners and 4 capital killers is we've got to decide which ones are in the show so we can be well prepared, whereas as an investor, when you're looking at things at the time, it's maybe not quite as easy. But I think the way you're going to run through today, which is explaining what the company was, what happened, and why we made our investment decision as a group the way we did, that's the real value here. It's not so much about this is the ticker I should run out and invest in or sell my shares if I own them. It's the process as to why this was a wealth winner or why it's a capital killer. So you can take that to look at companies today and determine what you should be doing with them, either on your own or ideally through us at Teaminvest.
Well, and the best part is because now we have the benefit of hindsight, which is always 20/20, we can go back and revise some of the decisions we'd made earlier on and look at some of these market darlings that were, darlings a few years ago who've fallen out of favor now, and just do a comparison of why Teaminvest members never would have looked at these companies to begin with.
And in fact, never did.
Yeah,
So perfect. Right. That's a great segue. So the first cab off the ranks in our wealth winner column is ResMed. Sanj, what makes ResMed such an amazing wealth winner other than that its share price has risen materially from, I think it got as low as $21 in 2023 up to $38 a share now. So that's a rise of 80% in only a couple of years. So what makes ResMed a wealth winner and what did you see in it?
Well, our members have been looking at ResMed and they've been watching its growth since about 2013. There's reports from back then and consistently throughout the times to show how they've been observing it, and consistently ResMed's been passing. So even at that time, it would have had about 10 years worth of history worth following, and ever since it's maintained its stability there. So ResMed has a high ROE. You would look back over the last 5-10 years and you'd be hard pressed to find any year where the ROE is less than 20%. You're looking at a stable company, and we have a metrics that we use called Stager, and this would score about an 85% stability rate, or Stager rate, which means that if it's a stable company, which you may have heard in one of our previous podcasts, if there's a stable company, it's much easier to calculate the chances of continuing the performance by using that rate. It has a return of about 20% per annum growth rate. So every year we're looking at the company at being 20% bigger than what it was. And that's been true for the last 5-6 years. The best part about ResMed is even though they have manufacturing, they have R&D, there's a lot going on in the business. They haven't needed to take out much debt to do it. So they're sitting at a debt to equity position now of about 18%, which is really low considering the size of the organization. And it doesn't pose much of a risk for us as investors when a business is carrying that much in terms of debt.
So just to recap, high return on equity, in other words, the business is able to generate material earnings from the capital employed, growing at a rapid click, the kind of rate that you'd expect from a software company, not a medical devices company, achieving that growth rate with a high degree of stability, so very predictable, doing it with little or no debt. And I'm guessing from the comments you've made there around the members covering it, and of course I know the answer, but for those here, very strong moats and low and understandable risks and management that are honest, trustworthy and capable. And that's our criteria for a wealth winner, aren't they?
Absolutely.
That the company is able to generate material wealth from the capital employed, grow quickly, do it in a stable manner, be honest, ethical and capable in the way they achieve it, have a competitive advantage and understandable risks.
Yeah, exactly. And it's because we understand the business that when things come up and spook the market and make the market fall out of love or get scared and run away, like this whole Ozempic saga that came out, we'd already been following the business. We have a deep understanding of what the business does, and we're able to get that collective group of wisdom from experts that know the industry very well, and they're able to educate the rest of us on whether that Ozempic saga is more of a story than it was based in any sort of truth.
Absolutely. And I think that's the point, isn't it, right? That in order to be a wealth winner or a capital killer, we'll come to capital killers in a second, at the end of the day, it comes down to the fundamental operating of the asset. Is the asset a good asset? And then once you know the asset is a good or bad asset, the question is, what is Mr. Market offering you? And I think in the case of ResMed, for those who remember only about a year and a half ago, the market decided to get very spooked off the news that new weight loss drugs may somehow affect ResMed, which does sleep apnea devices. Of course, those with a more understanding of the medical field would know that that were two areas that are unlinked. Sleep apnea and weight loss are definitely not correlated in the way that perhaps the market thought. And so the market gave our shareholders and those who wished to invest, who understood ResMed very well, a huge opportunity to buy a wonderful company at an incredible price.
Yeah, and that's for some of us that were a bit late to the party. The rest of our members were already holding it back when it was much cheaper than that anyway. So
Absolutely. And I think that's the final thing to say about a wealth winner, and we'll jump then into capital killers and replay it again, is that wealth winners are wealth winners because they can do this forever or for a very, very long time. The problem is so often that we can get caught up, I think, as investors in this idea that 1 or 2 good years is the beginning of something exciting. And of course, we know that statistically 1 or 2 good years is quite easy to achieve and is as likely to be chance as it is any underlying success. But if you can do something, those kind of growth rates, that kind of return on equity achieved with that little debt in that strong a way for 5, 10, 15, 20 years, that says that this company has got a defensible position that it can use to extract material wealth for its shareholders.
absolutely.
On the opposite side of ResMed now, Sanj, of course, is one of our first capital killers, which is Iluka Resources, which at about the same time as ResMed was tanking and falling out of market favor, getting down to around $21 a share. Iluka was spiking on the back of the idea that lithium was going to change the world and lithium prices were going to be high forever, reaching a peak of almost $11 a share. And for those people unfortunate enough to get caught up in that hype, other than the brokers that perhaps made a fee on that trade, you'd now be more than half underwater. So, you know, over 50% destruction of your capital, which I think is a pretty clear definition of a capital killer. So why is it that we at Teaminvest were never interested in Iluka Resources and were able to dodge that capital killing bomb?
There's probably several reasons for that, because Iluka is a miner. They're going to be cyclical by nature. If we look back at some of their history, you can see that they don't often make any sort of consistency in their earnings. Our stability index, the STAGR, which we often refer to, is at about 35%. So there's really no stability at all that can be applied to an organization like Iluka. It shows also, if you look at the last few years of earnings, they've been reducing their earnings by about 23% every year. So it's no surprise it doesn't come on our radar. The other part is we'd look at their return on equity. So from about 2015 till about 2018, you've had years of return on equity being 4%, negative 2%, positive 1.1%, then positive 28%. And then you go to 2020 and it's positive 188%, then it drops back down to 24%. So it's all over the place. So there's no sort of comfort you can get from thinking, I know that this will be a great investment to hold in my portfolio over the next few years, because things change so fast, so quickly.
And I think that comes back, we talk about stability a lot, and we've talked about it in previous episodes, but, that research from Drucker and Dreiman around the inability to forecast accurately, for analysts to forecast accurately at 1 quarter ahead, because the nature of the things they're being asked to forecast are so inherently unstable, and therefore your ability to understand value in an asset that's inherently unstable is, well, worse than flipping a coin. In fact, you'd be better off going to the pub on Anzac Day and betting your same amount of savings on 2-up as you are in a company with stability as low as 35%. And I think you see that borne out in the returns to shareholders in that period since.
Yeah, and if you look at the returns, it was at a high of around $11, over $11, and now if we look at it, it's around $3, under $4 now. So we can't say that we knew it was going to come off that much, but you just know that you can't know the company. You can't, with any sort of science or any sort of statistics, try and predict exactly what's going to happen and be able to sleep at night, because it is just taking a punt.
Well, I think what you can say is you have great certainty that it will continue to be unpredictable in the same way as it was before. All right, back over into the wealth winning side of the spectrum is a company that is definitely a market darling right now, and perhaps maybe a future capital killer up with where it's trading, which is ProMedicus. Now, I know we at Teaminvest have covered ProMedicus since I think 2009 originally, but certainly much more detail since 2017 at least, when the price was around $5 a share. It is up over 50 times that now, which is an astronomical amount. And I don't think necessarily we can get the credit for that. I mean, that's a combination of the company being very well run, but also I think the market falling in love with this in a way that is almost comical. So perhaps what we'll do is talk about why it was that we had so much confidence in the past that ProMedicus would be a wealth winner, and perhaps where those cracks are now starting to show, because I think this is one where the underlying company is a fantastic business, and you'll talk about that, I'm sure, but that Mr. Market has now talked it up into a price that I think has much more risk to the downside than it could ever be to the upside from here.
Yeah, and the market's just catching on to what our Teaminvest members knew all the time. If you look back at some of the earlier notes and you look back at the history, it's easy to see that ProMedicus has a stability rate, that STAGR rate, of 96%. And 96% is fantastic. And it means that every year they're consistently growing their earnings. And in this case, their earnings per share about 35% every year. So the high growth, and it's done very stably. So from that, you know that you can invest in a company like this, and there is a very solid chance it will continue its next results in line with that. Their return on equity consistently over about 20%. It's going as high as 40s in its 40% in 2021. It's even the last few years has been like that. But it is a very stable company. And again, it doesn't have to take the risks of taking out too much debt. It hardly has any debt on their books. But that consistent growth allows us to say, okay, this is a company that knows how to make money and operate as a business. So from 2017, when our members were, let's say the bulk of the members were looking at it, you would have been there at a share price around that $5-6 mark. And that's when most of our members got into it. Now we're looking at a share price around $280. So I wish I was back there with the members at the time when they got into it. I've missed that boat. But it's no surprise when we see a price shoot up like that. It's because we know that the company is earning. You know the company can continue to earn profit. And what are the chances or the risks of it going bankrupt when they keep growing their earnings?
Yeah, absolutely. I think so. Again, if we come back to our checklist, incredibly high return on equity achieved with little or no debt, earnings growing very quickly with high stability, management that's honest, ethical, capable, and hardworking, demonstrates a partner's mentality, strong moats around their product and services, well understood risks, that was in the past available at a very reasonable price. I think the concern now, Sanj, and maybe we're going a little off topic, but I think PME is at risk of potentially being a capital killer in the future. Not as a company. I think the company will do great, but I think that share price is now completely unsustainable. I mean, we're talking PE ratios now of close to 300 times compared to 20 times average historically for the market. That's a long way to fall if the market returns to treating this like it treats other companies. Now, having said that, if you paid $5 a share and it drops, do you care? I mean, you're still up huge amounts of money, right? Absolutely. But I think anyone listening to this podcast now, or any member, as I know we've talked about a lot in our meetings, would be very wise not to get excited in the market hype that is today around PME, as opposed to back 5-10 years ago when PME was not exciting to the market. It was a small little medical imaging company that people hadn't heard of, but was showing incredible signs statistically that this was going to be something special.
Yeah, and if you look at it, I mean, I did the calculations on it, and if PME was trading at a PE of around 30 or so, you're looking at a share price of $23. So if you still bought it at $5 and went up to $23,
4 or 5 times your money, right?
You'd be very happy. But it's showing such a great or such a high share price, and that's through no fault of the management, or it's the management been running really successful business. It'd be unfortunate for them to be penalized by a falling share price, but eventually it's going to have to come back off. It's just unsustainably high.
What's that lovely old line? You may not believe in gravity, but gravity believes in you.
That's it.
All right, on the other side of the ledger, another one of our capital killers is Lendlease, another very large Australian company that I'm sure many people listening to the podcast are intimately familiar with. Back in 2018, trading at $20 a share, now down in the fives, I think $5.70 at the moment, so you would have lost 75% roughly of your money investing in Lendlease over the last sort of 5-6 years. What is it that scared our members and us about Lendlease in the past, which is why we were able to avoid this capital killer?
Well, looking back at it, you can see the first thing we start off with is its stability. Are we able to form any sort of reasonable prediction based on how stable the company's been growing its earnings? In Lendlease's case, it's worse than Iluka, where it's about a 30% stability rate. Now, even from its earnings growth, it hasn't grown. It's been reducing at a rate of about 37% year on year. So 37% decline in earnings over the last 5-6 years. You would expect better from a company like Lendlease. And even if you look at the return on equity position, it doesn't do much. There's a couple of years where it's scraped over around 12% return on equity, but mostly it's been under that and sometimes even in the negatives. So it's not a company that would ever come on our radar, but the market's loved it. And I have no idea why the market thought that this was going to be such a wealth winner, or, market doesn't call it wealth winners, we do, but why the market fell in love with a business like this.
So just to recap, it's a business that has anemic return on equity, single digits mostly, going backwards in growth. So not growing forwards, but shrinking, doing so with a huge degree of unpredictability in its ability to earn or make a prediction about its earnings going forward. What's its debt to equity like?
At present, it's sitting around 93. It wasn't always that high, around that 40, 50 mark.
So
But
it's not only
93% debt to equity, it's really on the high side.
yeah. So not only has it been shrinking, but it's been taking on more debt to shrink,
Yeah.
which is never a great sign. And yet, for a while there, probably because of the fact that it's such a household name in construction, the market had fallen in love with it and was offering it at a ridiculous price, which unfortunately I'm sure some people were on the other side of, mainly because of that lovely story of what sells stocks is stories.
Yeah, well, I
and
mean,
names.
You're looking at it back in 23, the PE got as high as 100 times.
Which is ridiculous,
So yeah,
for a company that's shrinking.
that's right. And you think, they'd have some sort of land, assets, construction. They have things that would be of value, but
they're boring. They're not 100 PE.
no way.
Absolutely. All right, back to the wealth winning side of the equation, TechnologyOne, a company I know we've been covering since I think 2007. But if we just look at the last 10 years ago in 2015, share price of around $4 a share, around $40 a share now. That's a tenfold increase. And seems to be growing as a company, its earnings at a sort of 15 to 20% growth rate every year with great replicability. And I think that I've just seen Ed Chung and the team announce that they are reiterating that growth target for another 5 years. So, Sanj, what is it about TNE that attracted us all the way back 10 years ago when it was a much, much smaller business and many people's eyes wasn't worth the effort of covering?
Okay, so again, we start with the stability. Is it stable enough to form a prediction on? Yes, our Steiger score on this would be 98%. So 98% certainty around its ability to grow its earnings. And that growth is sitting at around 14% every year. So the return on equity is consistently high, usually in the 30s, mostly over 20. I don't see it going below 20 either in the last 10 years. But they've keep growing it, extremely stable, maybe a boring business, but it doesn't have to do anything spectacular. It just keeps growing.
I don't mind a boring business that makes me 10 times my money.
Yeah, absolutely. And again, it's one that doesn't have to carry a lot of debt to do it.
Absolutely. And we keep coming back to those themes, don't we? High return on equity achieved with little or no debt, earnings growing faster than inflation, achieved with a very high degree of stability, strong moats, understandable risks, honest, capable management with a partner's mentality, and critically for an investor, as opposed to for the company owner, available at a price when the market hadn't realized that.
Yeah, that's right. I mean, our members were getting into this back in around 2017, 2018 in a big way. And that's when the price was sitting around that $5 mark. Now we're seeing it above or almost $40 now. But it's no surprise to us when we see these companies doing this well. I don't know how well it'll continue to do in terms of its share price, but I know how well it'll continue to do in terms of its earnings.
And that's actually a really good distinction to make, isn't it? We've spent all of this section today focused on identifying wealth winners and capital killers through the fundamental performance of the business, how the business itself is going, and then being able to say if the market has got that wrong, that's an opportunity to buy or sell. As opposed to, I think, most participants in the market who start with where the share price is going and then ask, is it worth it? That's flipping the message around, and it's a significant difference in how you look at the question and how we look at the question. All right, moving on, but sticking with the letter T, one of our capital killers. I know those who've followed us for a long time will know we've talked about it ad nauseum for, well, literally since we started in 2007. But Telstra, a perennial capital killer. 10 years ago, Telstra, in comparison to TNE, was $6.50 a share when TNE was $4. And today, Telstra is $4.50 a share while TNE is $40. So that's a 33% reduction roughly in the nominal value of those shares, despite the fact that in that period, of course, with inflation, it probably means in purchasing power. An investment in Telstra, which is meant to be a really stable dividend protection yield, has probably meant that you've lost north of half of your wealth had you invested in Telstra back in 2015. So what was it about Telstra that made it a capital killer then and, we keep talking about makes it a capital killer today?
So with Telstra, if we again start with the stability, it's at 87% stability rate, which is fantastic. You think A stable company allows us to make a solid prediction. Now, if we look at the growth is at -9%. So it's actually growing backwards. Every year, the returns keep shrinking. So is it no surprise that people have lost money on it? No, it's exactly what we would have expected from following Telstra that long. Almost every member that comes to Teaminvest, that starts at Teaminvest after being at a financial planner, generally started having, or at some point had, Telstra as part of their portfolio. And they've joined here at Teaminvest, looked at the business, and then realized this thing is just going to keep eroding my capital away bit by bit every year. So it's not something that you'd want to have. And the debt is currently sitting around 115% debt to equity. It goes as high as 120, but it's pretty much more debt than there is equity in the business.
Absolutely. And that's I suppose, a very dangerous cocktail, isn't it? A company shrinking with huge stability, so you can be almost certain it will shrink in future, owing more than $1 of debt for every dollar of equity. Almost sounds like a federal government deficit.
I'm just waiting for the day that they'll need a bailout. I'm sure there'll be all rights payers bailing them out of that.
All right, back onto the wealth winning side of the equation, JB Hi-Fi. So we've talked about medical device companies, technology companies, now to a boring retail company. What is it about JB Hi-Fi that makes it so exciting for us at Teaminvest? And why is it that when the share price was as low as $20 on a single-digit PE in 2019 and 2020, you and I were out there in front of everyone saying this is one of the forgotten gems in the market. Of course, we look geniuses now because it's up 5 times, but at the time we didn't know where it was going to go to. We just knew that number looked wrong.
Yeah, that's right. We knew the PE was wrong, but we did know that JB Hi-Fi came out, well, the day in our stability index where we're going to start always, it's about 85%. So we can make an 85% surety on the assumption that it's going to continue on its current path. The growth rate is at 17%.
Which is incredibly fast for a retailer.
For a retailer especially. I mean, they've got to have really good moats behind what they do to be able to grow that fast as a retailer. And what's surprising, which sets JB Hi-Fi apart from pretty much every other retailer out there, is they don't take on a lot of debt. Now, they do have quite a bit of debt, or when I say a bit of debt, they're around 42% debt to equity. But for a retailer, that 42%, let's say, includes their leases, and think about how many sites JB Hi-Fi has to have around the country, it's relatively very little that you need from a JB Hi-Fi point of view. And the way that they do business is much better than most retailers out there.
Absolutely. I mean, that's actually a really interesting point. So with the change in accounting standards a couple of years ago now, leases are included in debt. So our debt figures that we quote are both the debt owing to banks, the debt owing to bondholders, and leases. And we'll probably run a whole podcast as to why leases should be considered debts, but that's not for today. No. But what is interesting is you talk about, wealth winners being those with strong competitive advantages. So usually the best 1 or 2 businesses in an industry. And here's JB Hi-Fi in an industry with a notoriously high debt to equity ratio industry coming out with numbers that are very much within the safe category for any business, let alone a retailer, whilst achieving incredible growth rates of earnings in apparently a period of poor retailers doing it tough. With an incredibly high degree of stability. Coming on to the other side of the equation, a former market darling from 2021, another one of our capital killers, is IDP Education. If you had been in IDP Education back then, you would have lost over 80% of the value in your capital compared to today. Now, Sanj, IDP is an interesting one, isn't it? Because IDP very briefly there did pass our quantitative filters, but it failed on the second half of those questions about what makes a wealth winner. So when we talk about what makes a wealth winner, as you've heard a few times today now, there is a series of quantitative metrics: return on equity, debt to equity, earnings growth rate, stability of earnings. And there are also some qualitative metrics, things like, are the management honest, trustworthy, and capable? What are the competitive advantages of the business and how strong are they? Its moats. What are the risks and how high are they? And then overall, we take a pass in all of those sections before we're prepared to call something a wealth winner. And that's to avoid false positives. Statistically, there's always going to be something that can slip through a quantitative filter just by fluke. And it appears, I think, in the list of questions you gave me for this one, when we were preparing for the podcast, that IDP Education falls into that false positives test, didn't it?
Yeah.
Can you talk us through what we mean by a false positive and why we then, our members, when looking at IDP Education, rejected it?
Well, it's an interesting one. So if we start with the stability, 75%, so it scrapes through what we would think is reasonably stable, has a growth rate of about 15%. So their returns, their growth, stability is not bad. Their debt currently a little bit higher, they're around the 75% debt to equity mark, but usually around the 30 to 50 mark. So it's passable amount. So from a data point of view, it doesn't look too bad. So the members actually picked it up and had a look into it further. When they did, what did they find? Well, I'll read the comment here. The members voted against investing into IDP. The comments were, the members were concerned about the trustworthiness and the competence of management, the lack of skin in the game, the new CEO and CFO, and the skills metrics of the board. So it was really around the ability of management to grow this business into the future, even though that statistically on paper, the business looked really well or looked really good. Management was just that turnoff for them. And then what happened since then?
The rest is history, as they say. Yeah, and I think that's such an interesting point, isn't it, right? Because the real strength in what we do and the real strength that you can do at home if you want and have the time on your own or with us is to separate two series of questions out there. The first is quantitatively, does this business give me a really good chance of making money? Is it predictable? Is it growing in the right direction? Is it achieving good return on equity? Can management, in other words, earn good returns for the money that they've been employed to do? What are the moats of the business? Is this a strong, stable business? And then on the other side, use the wisdom of your own insight and the wisdom of your fellow investors to ask those softer questions, those qualitative questions. Things like, is this the right management to take it forward? Do they have a partner's mentality? Is there a risk over the horizon that we can see that hasn't yet fed through in the numbers? And the good example I know you and I use of that all the time is, things like fax machines and digital cameras. If you were in Kodak, you could have seen the rise of digital cameras well before the annual accounting statements would have shown through the loss in their film business. So, that's where you can use the wisdom of the crowd. And then what you need to do, of course, is put those two pieces together to determine, is this a potential wealth winner or not? We've got our seven checklist. And then, of course, what's a reasonable price to pay? Now, that's not the purpose of this podcast today, but what I hope everyone listening has got some value out of, and I know certainly I do every time we go through this, is how many wealth winners hide in plain sight and how many capital killers hide in plain sight. And I would argue are often spoken about more because almost by definition, the companies that are going to be wealth winners are those boring companies that do something really cool, like really smart, but they do it well and niche, and they stick to their knitting and they grow that time after time after time. And so the market doesn't realize about it until it's too late. And then suddenly the price is up 10 times and you look like a genius. And on the other side of the equation, capital killers are almost always capital killers because they were caught up in hype.
Yeah.
Something that wasn't particularly good, perhaps a dog gets a unicorn label, unicorn status, perhaps just because they put an ice cream cone on its head.
Yeah.
And I think that's the classic challenge, isn't it, with a capital killer, is that it's the story that makes it exciting. But when you actually look into it, you peel off that paint, you realize this isn't a pink creature. It's a brown, mangy one painted pink.
Yeah.
My daughter has got the book Thelma the Unicorn. I don't know if you've read it, but for those at home, if you've got young kids, I'm sure you have. It's sort of a great Australian cult classic. And it's so true. Grab a horse, stick a carrot on its head and dump pink paint on it, and people think it's a unicorn, but it's still a horse.
Yeah.
And I think that's the same problem so often with capital killers, is that we get caught up in the story, the pink paint, the gold horn, and we forget that at the end of the day, it's still a horse.
Oh, that's the thing. I mean, you go out, you raise money for these organizations, and coming back to my experience as a broker, I saw it many, many, many times. This is what you have to do. The company doesn't ask you for money when they don't need it. They're asking you because they need it. So they paint the prettiest picture, the pink paint, the carrot, dress it all up and say this is the best looking unicorn you've ever seen. And, peel it away. And then what did we actually start with before we had to dress it up? It was the dog. Right?
And on that note, thank you, everyone. If you'd like to find out more about how you can identify wealth winners and avoid capital killers, make sure to reach out to the team here at Teaminvest and Tip. It's something we do very well, and we would love to tell you more about it. Thank you.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.